Well, hey, thanks everyone for joining so far, and welcome to Inspire's first webinar in a little while. We've actually been up to a few bits and pieces over the last few weeks and months, but this is our first one in our new office. Is one of those big announcements. We've actually moved offices. We're in the same building we were in Brisbane, but we've just gone from the ground floor to level 2. And added quite a few more square meters in space for our growing team. So it's very a welcomed move. But thanks for joining. We are going to be talking today about asset protection. And I guess in a sense, what we want to make sure is that when business owners go into business, we want to make sure we protect the downside or the potential risk that business brings. So we're going to be going through some 101 stuff right up to the advanced things. And I guess what my encouragement is for you today, before we get into it, is if you've got some questions that you want answered, can you please pop them into the chat box? I did have a look through. Some people filled that box out when they registered for today's webinar, but I really want this interactive, and you'll get more value out of it. I'll enjoy it more. I'll kind of know where everyone's keen to sort of go with the conversations, but we can use either the Q&A box or the chat box to ask those questions. So please start popping them in now if you've got them now. Otherwise, I've got them on my screen. I can keep an eye on as we go. So in terms of a bit of an introduction to Inspire and me, if it's your first time joining me on a webinar, my name is Ben Walker, and I run an accounting firm in Brisbane called Inspire. And that's a recent photo of our leadership team up on the roof, which was a bit of a celebration of the new office, but we're really proud of the impact we have in our clients. Particularly, we kicked over a number of $22 million in tax savings, proactive tax savings, and counting. That was at the recent tax planning season that ended on 30 June, just gone. So that is a bit about us. And in terms of me personally, I started Inspire when I was 23 years old, a little while ago now. I'm an award-winning chartered accountant with 13 years of experience. And that fun fact down the bottom, I'm the author of Wealth for Life. I'll speak about that very shortly because there's some pretty exciting news there. Now, in terms of the people special to me, this is my lovely family. I've got my wife, Stevie, on the left. And in this photo, she's actually pregnant with our third baby girl, who's due any week now. So technically the due date is about a week and a half away. So I'm both excited and nervous if I see a phone call from my wife, what it's going to be. But yeah, and then our son, Ezra, there's me, and our cheeky daughter, Rose. So that is the special people in my life. Now, in terms of the Wealth for Life book, this is something that has been recently published. And by recently, I mean literally about a week and a half ago. This was I received the first box of books at my house for Wealth for Life. Now, with this, I've actually documented the 9 steps that business owners need to take when they're looking to create wealth for their families. So it is a step-by-step guide. I've put a ton of information in there, things like, making sure you've got a backup plan in place, in terms of your estate planning as well. We want to make sure that's done properly. Self-managed superannuation, there's a whole chapter. It's probably one of the biggest chapters in there on SMSFs, or self-managed super. We talk about investments, property, and also making sure we're leveraging debt as well. So there's plenty more than that. But if you do want a copy, I think, Rose has actually posted a link in the chat box right now. And if you use the word protection, that's the asset protection word, so protection, then the first 10 people to order that online can get free shipping with that. So check out the link that Rose has just posted in the chat box if you want to get your copy of the book. Now, I have seen some people that have registered for our book launch who are live online today. The book launch is actually tomorrow night. If you have registered for that, you'll get a copy of your book when you come along. So you don't need to go and purchase that right now. So do keep that in mind. But if you do want a copy, use that coupon code protection, and the first 10 will get free shipping with it. And if you do want to join, last minute join of the book launch, I think we've got a few spots left. Rose, would you be able to just pop the link for the Eventbrite book launch? And if you do want to join, Rose will post those details in a sec, where it's tomorrow night, Friday night, in Brisbane from 5 p.m. And I think we'll finish up around 7. But we've got drinks and nibblies and a free copy of the book. So feel free to check that out. Also, we're going to be speaking about lots of different accounting-y topics. Asset protection is our focus here, but we might talk about some side topics like tax or structures and things like that. If you do have some questions you'd like to bounce around with an accountant after the session today, then please book in for a strategy call. The link will be in the chat box shortly. Otherwise, it's inspire.accountants/chat. So that would be the link for if you do want to have one of those chats with our accounting team. Alrighty. Now, in terms of what we're covering in today's webinar, I'll just run over this at a high level, but we've got Asset Protection 101, so some really basic stuff. We'll talk about the concept of risk taker versus asset person. Which name do you buy the house in? And then common structures to run businesses out of, common structures to run investments out of, and then we've got asset protection, advanced asset protection. So, and what I want to encourage is, as I said, there's a few people who've joined since I mentioned this, but question and answer, Q&A is absolutely important for me to be able to work out where to go. Now, Olivia has just posted a message saying, okay, I've just enabled chat there. Olivia, thank you for the pickup. Can you just confirm in the chat box that you can use it? Alrighty, so I hope that's just fixed the problem. Awesome, thanks, Olivia. Okay, so now we can use the chat box and the Q&A thing. Oh, Lisa, cool, good to see you here. So where was I? I was talking about Q&A. Please ask questions. This works better if you do. You get more value if you do as well. So cool. Alrighty, asset protection 101s. So again, this is sort of the introductory stuff to asset protection. If you've joined me on a structuring webinar before, some of this might have been familiar to you, but I think it's important we go through it, given the focus here is on asset protection as a whole. So I guess, why should you be worried as a business owner? That's kind of the question that I guess we should first answer. And the answer to that is, there's multiple different types of risk when you run a business. You know, and the risk, another way to put the risk is what's the different ways you're going to get sued running a business. And who are you going to get sued by potentially? So what we've got here is the 4 main types of risk. And the first one is clients. So people who pay money to you. You've got a contract there. Ideally, there's a contract, like a legal document that supports that. But you know, there's many different ways that you may get into trouble with a client suing you if you don't deliver on promises, or something bad happens with them. You know, they suffer a loss and it's your fault, that sort of thing. So we want to make sure that we protect ourselves from client risk, and you can do that through, you know, professional indemnity insurance and things like that. But also, what we're going to talk about today is that structuring, like regardless of the type of risk, there's other ways we can do that as well. Employees. So unfortunately, the employment law in Australia is not geared in favour of the employer, but it is in favour of the employee. So unfortunately, it's quite easy for employees to be a bit of a thorn in the side if they want to be, from a fair work perspective. If they, you know, go and complain about whatever it is, and I'm not encouraging people here to be reckless or to go about things, you know, almost like getting ready to be reported or sued or whatever it is. But this is, we want to be, what I always have in mind when I talk about risk is let's be fair with clients, fair with employees, suppliers, competitors. But even still, even with that overlay of fair in mind, we may still get into a bit of hot water. So in terms of suppliers, that's people who you pay money to. You know, if you're paying rent late, the landlord might be sending you demands, or we're not paying loans back to banks or ATO. I'd kind of put all of them into a category of people you pay money to as suppliers, and making sure we manage those relationships. But again, that's a potential risk for us. And then competitors, I don't think this is a strong one, but my context here for competitors and why I put that in is probably the biggest risk with competitors is if you, if you nick some of their IP, or, you start copying copy off the website, things like that, or trademarks, bits and pieces, and you might get into hot water there. So that's another one we want to be aware of and make sure we have that in mind. Alrighty, I can't see any questions, so hopefully I'm answering any ones that might pop up as I go. Now we'll switch gears into what I call the risk spectrum. Again, this might be a familiar diagram to some people, but I'll walk through this one. So we've got we can choose different types of entities when we structure a business, and I've got the first one, the most popular actually, being sole trader. It might be the most popular, but it's actually the worst structure. So I hope we don't have any or many sole traders on the call. We want to be having companies and trusts, or a combination of both, for your business structures when we set that up as accountants. So there's a few reasons why. That tax is a huge reason why. Sole trader makes it very difficult for tax planning versus companies and trusts. But the big one here is asset protection. So again, that's our focus. And so if you've got assets in your own name and your business gets sued, then literally your personal assets, even your home, your car, things like that, can be used to pay back creditors or the person suing you. Now, if we look at companies or trusts, if this risk spectrum, if we look at it as a line, we've got left to right. Left is high risk, right is low risk. If we look at companies and trusts, they take us a fair way away, like halfway along this spectrum I've drawn up. And that's because of this thing called ASIC's corporate veil. So you see the brick wall between the person over here and the entities here. Now, the reason why there's a brick wall here is ASIC's corporate veil. It basically says that companies are actually separate legal entities from the directors and the shareholders of the companies. And it puts this wall here in between. So if the business is sued over here, then they're suing the business, not the person and their personal assets as well with that. Now, a couple of things to keep in mind, though. There's three things that can get through this ASIC's corporate veil, and I've drawn them here. The first one is fraud. Now, in the spirit of being fair, if you're committing fraud and your personal assets get taken, I absolutely don't have sympathy for you. Like fraud's intentional disregard or producing documents, etc., of wanting to defraud someone. So what? That should get through that corporate veil for sure. The next one is directors' guarantees. Now, these are very common on commercial leases or even finance agreements. So if you're buying a car for business, or even taking an overdraft out for your business, that sort of thing, you might see this thing called a director's guarantee. And even suppliers, depending on your industry, some suppliers will actually have this included in their contract by default. And what it means is, if the entity cannot pay the bill, so if your company or trust cannot pay the bill, then the director has guaranteed it will pay the bill for the company or trust. So, so the supplier can actually come after the personal assets of the director if they've signed a director's guarantee. So I hope that makes sense. And the third one is insolvent trading. So the definition of insolvent trading is that the entity is unable to pay their bills as and when they are due. So, and this is kind of a bit of a grey area that needs to be argued and determined in court usually. But things like, you're not paying your BAS on time, or you're needing payment arrangements, or, rent is consistently late. Big ones, super's not being paid on time. That's a flag. So things like that is indications that you're trading insolvent. And again, if that's proven, the creditors can come after the personal assets of the director. All right. So if we look at the spectrum as a whole, again, we've got this big line. Companies and trusts take us further along here. Now, there's a further along the spectrum where we've got this thing called $0. Now, what I'm kind of hinting at there is that for better asset protection than a company or trust, the directors of the trading entities are actually worth nothing. They have $0 in personal assets. Now, what that means is that, again, I don't have sympathy for fraud, but some of these stuff, like let's say you're having a genuine crack at business and, you know, COVID hits, things out of your control and you end up trading insolvent, you know, and they get through the corporate veil. Even if they do, you've got your assets set up in such a way that there's no consideration that could be paid anyway. And in a sense that you're actually a step further than having a company or trust. There's, I guess in a way you don't want to be a target to come after to get your personal assets. And if we think personal assets, again, we're thinking family home, your share portfolios, investment properties, things like that. We absolutely do not want in the director of the business's personal name. So that is probably one of the best overviews of asset protection I can give. And now we're going to kind of dive down into the, I guess the topics within what I've spoken about. So I might just pause and see whether there's any questions that are popping up. You know, I haven't seen any come in, but please, 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 if any of this is not making sense, please ask the question, or if you want to dive deeper into something, then flag that in the chat box or the Q&A. So the next topic we're going to run through is this concept called the risk taker and the asset person. Now, if you've done a structuring session with us, you'll be familiar with this, and you may even know which one of these two you are. But what we often do is if we've got a family we're advising for, and there's two spouses, we've got husband and wife, let's say, we appoint them one of them as the risk taker, and I mean, it's in the name, they take all the risk, but they also own nothing. So if we flick back to this diagram, the directors, the risk taker is over here, and they've got $0 of assets in their name. Now that's ideal. Not every client comes to us and they've got $0 in assets in the risk taker's name. So, but again, it's the concept here is teaching the idea of it. And then if it's not set up like that, we work out what the strategy is over time to end up in a more ideal spot. And if we have a look at the asset person, this is usually the person who's less involved in the business. We deem them the asset person. They take no risk. Takes no risk. That's a grammar thing, but they take no risk in the business. They're not a director, and they own or control everything in the family wealth sphere. So cool. So Howard's asked a question, which I will have actually preempted. So I think that's about 2 slides away. So I'll get to that in a sec, Howard. Thank you. Now, go a bit further than that. So what we do with the risk taker is they are usually the director for trading entities, and the asset person is the shareholder, appointer, or appointer for the other entities, so trusts and companies, that sort of thing. Cool. And I will just go through. So I've got some Q&A here, and I've seen Olivia's question too. Great. So I'll go through this first one. What happens in divorce or partner or relationship breakdown? Now, if we've got one person with $0 in their name and the asset person with everything in their name, and you look at the word divorce, every single time I share this concept, literally every time over the last 10 years I've shared this question comes up. Now, we've spoken to multiple family lawyers about this question, and their answer to it is that if the asset person and the risk taker were to split up or divorce or relationship breakdown, then the assets in the asset person's name are actually considered marital assets, and that's dealt with under the family court. Now, you can't ever say it'll be split 50-50. That's to be determined under the family court and all of the things they take into account. But the benefit of it is that it's not just the risk taker who walks away with nothing and the asset person walks away with everything. Now, a practical thing to consider with this, though, is if everything is in the asset person's name, then they could literally sell the asset because they don't need the risk taker's sign off. If it's not, let's say it's the family home and it's owned 100% in the asset person's name, that they don't need a second signature to go and sell that. So they can be an interesting pain if they know what they're doing there. But again, if they start acting not in the best interest of both of you, then that has ramifications in the family court as well. So please keep that in mind. Like if, let's say they sell the family home for $1, like, oof, they do get in trouble. What if you don't have a spouse? PS, I can see the questions coming in. Very good. If you don't have a spouse, then unfortunately we can't implement this scenario for you. Sometimes we have used close family members, but I feel like that has other risks because let's say you use your mum or your dad as an example. What happens is if we put your assets in their name, that becomes complex for borrowing purposes, complex for when they pass away, what happens. If you've got other siblings, then the assets you put in their name or in their control may be dealt with under their will. And, you know, maybe your siblings, if you don't have a great relationship with them, could contest and say, no, they're my parents' assets. I need a share of that too. So yeah, I feel like if you don't have a spouse to implement this strategy with, we're pretty limited. And again, I don't like doing the parent option, even though we have. And the other thing, sorry, I was just going to flick back to an earlier slide. But this one here, the spectrum. Now, sometimes with structuring, let's say we don't have a spouse, we can't actually achieve this level of asset protection. We can't be worth $0 on paper because the director needs, you know, they might want to buy a house to live in, that sort of thing. So the maximum protection they can get in that circumstance usually is to set up a company or a trust and make sure we do our best to guard against these things that can come and take the directors or the risk takers' assets. There are other advanced strategies as well, which I will actually touch on, that if this is the case, if you don't have a spouse, then we can look to implement as well. What about estate planning? Again, a great consideration when we're looking to set up structures. But in terms of estate planning, the idea there is where do the assets go when the people pass away? So what we don't want, let's say, is the asset person passing away and all the assets now end up in the risk taker's name. Now, if they're running a business, let's say they're now immediately worth $1 million when asset person passes away, that's unideal. There's things we can do like setting up testamentary trusts that actually deal with that. And so they don't go into the risk taker's name, they get separated into a testamentary trust and protected against the risk that this person has. So there's things we can do there. Alrighty, I'm going to get stuck into some Q&A now. So we've got the first one here. With the director owning, oh, sorry, I have answered that one, Howard, with relationship breakdown. So Phil has asked where the directors originally have their own home in their name. Can it be moved into a trust, or is there another way to protect without having to sell it? So when you sell the family home, you'll get hit with stamp duty on that transfer. Now, in terms of ways you can fix that, and often when we share these concepts with clients, they're in a position where they might jointly own the family home. Now they've got options. They can leave it as is and accept that that's a risk, or they can move it into, let's say, one of the person's name. I'm not too much of a fan on moving it into a trust, not the family home. There's downsides to that. But let's say it's we want to get it into one person's name, into the single spouse. That's an option. We take that stamp duty hit. If it's always been the family home, then there shouldn't be any capital gains tax implications of that. So that's one solution. And then the other solution, Phil, is actually an advanced asset protection method that I'll share later, which is called the gift and loan back. So keep that in mind when we get to that slide a bit later. Mark, I think I've answered your question too. Good to see you, mate. So yeah, we can actually move it and cop the stamp duty hit or the gift and loan back as well for that one, Mark. Damien, the asset person holds the assets in trust for both parties to the marriage. That's the idea, Damien. Yeah, they either own the assets directly or control them via trusts. How does this get wound out if you decide to immigrate, leave Australia? Great question. There's a whole heap of intense capital gains tax legislation around becoming a non-resident. That is probably beyond the scope of this webinar, but you'd have to make some decisions whether you hold or sell assets at the time and consider the tax implications of that, Howard. All righty. Olivia, if a company being... I'm going to read this in my head first. Okay, so Olivia has asked a question, which I'll kind of answer now. So, but I do have more info on this in a few slides. So he's asked, with the company being a corporate trustee of a trading trust, are the shareholders liable for the risk? The quick answer is no, they're not. Shareholders are not liable for the risk of the running of the business. It's only the directors there. And I might say only the directors. Again, there's a few asterisks to this. Let's say we've got a risk taker who's the primary person running the business, and we've got the spouse who is involved in the business, but they're actually involved in decision making, hiring, firing, entering into contracts with clients. Then it could be proven, it's hard to prove, but it could be proven that this asset person is what they call a shadow director, which is basically they're not a director on the asset register, but they're acting as one anyway. Now what that does is that actually the result of that, if that's proven, is they are classed as a director. So we want to watch that as well. Yeah, so there's a few different things to consider, but the risk of shadow directorship is one of them as well. Where an account or lease pierces the veil, is the guarantee limited to loss on that account? Okay, so Chris, so I think Chris has asked about the director's guarantee. Now, my understanding of this is that, let's say you've got a bank loan for a car. You've bought a car in the business. It's in the business name, the loan's in the trust name or the company name, but it's got a director guarantee. If this entity stops paying the bill, the bank comes after the director who signed the guarantee for that amount. Now, my understanding is that doesn't open the floodgates for every other creditor to do the same thing. It's just guaranteed between the parties who've done that director's guarantee. So that could be the landlord if you've signed one there, banks, suppliers. They're kind of the three main ones that you'll see directors' guarantees. But again, it doesn't open that up. Also, Chris, you've got another one actually beating me to the slide. Why not have the family home in a family trust? A big one there is with buying the family home in a personal name. We want to make sure we get things like the capital gains tax main residence exemption when we sell that house later. There's stamp duty concessions for being bought in as a home in your own name. There's those sort of things which often outweigh benefits of putting the family home in a trust name. And the other thing to consider there is the setup and admin fees of a trust as well. That's another, call it tax if you want, tax from the accountant, to go and manage that as well. So there's only limited situations where I've seen it actually make sense, but as a general rule, we would pretty much always put the family home in the asset person's name. I'm an example where our family home is in Stevie's name, my wife. So I mean, I'm not doing anything different to what I'm recommending there too. And the other thing to keep in mind is risk is a spectrum. So some clients are still not happy with the family home being in the asset person's name, for instance, and a trust is another level again of protection. So, you know, again, risk being a spectrum, if we if we jump back to the line here, on the left-hand side of the screen is actually, this is like the cheapest form of asset protection. It doesn't cost you anything to set up a sole trader, apart from like registering an ABN, which is free, or your accountant, you might get to help, versus a company or trust, you're looking at a few grand to get that set up. And if we want to do advanced asset protection things like we'll mention later, it just costs money. So the further to the right you want to be, the further along the asset protected spectrum you'll want to be, the more money you're up for, whether it's accounting fees, legal fees, stamp duty, all of those sort of things. And my perspective is that there should be a fair balance, that you're probably never going to be 100% protected, but you can get fairly protected for a reasonable amount of money. But again, you want to start doing the Fort Knox approach, then we could go even further than that. Chris has asked, do I hold 1% of the family home? And my answer is no. So if you do a property search with me, property searches you can pay for, where you can search a director's name, you'll see that every bit of property that person owns. I don't want to show up on a search, so I did not own even 1% of my home. Now, I know people who do. Now, the thought process there is that your spouse or the asset person actually does need your signature to sell that property. So that may be a reason why you actually hold 1% versus 99% being in the asset person's name. Good amount of Q&A. Alrighty. Now, last point here on the family home, how does the bank see it? So what if you've got 100% of the asset in your spouse's name and none in yours? Is your income able to be used by the banks? Again, my experience is, and I used to be a mortgage broker. I did mortgage broking throughout the last few years. The banks actually do look at both. If you're looking at a business owner, they look at the income from the structures, and also when you're buying a house, they'll look at the person buying it plus their spouse generally. So, I'm sure you'll find a situation where they don't, but the majority of banks, there's no problems with this ownership of 100% in one and nothing in the other. And sometimes they just want an answer to it, and like, why is it like that? And asset protection is the answer that that they've been happy with to date. So that's the answer there. Alrighty, we are going to change topics now into structuring. So how do we structure businesses? Now, I'm going to say that there's two main ways to structure your business. There's more than this, but the two main ways, where we've got a trust that operates the business, and at Inspire, we draw trusts as squares, and the company is the trustee. So a trust in Australia needs this thing called a trustee to operate it or make decisions on its behalf. And your choice with a trust is having a company or an individual act as the trustee. So in terms of business trusts, we would absolutely recommend that you have a company as trustee because of the protection it gives with that corporate veil. So this is one of the main ways we see structures take place is operating out of the trust with a corporate or a company trustee. The other way is to have a company that trades and operates the business, and the trust is the shareholder. Now, the reason why we want that trust as a shareholder is because from a tax perspective, we can actually distribute the dividends received from the company to the trust. We can distribute that between the family members in this family group. And in terms of the income, if this is a discretionary or family trust that operates the business, we can usually distribute the profits between the different family members. So it gives us tax flexibility. We do see a common mistake with people who set up companies to trade, that they just have themselves as individuals being the shareholders. There's quite a few problems with that. So we definitely don't like seeing that at all. But the problems are particularly tax problems, asset protection as well. If the business here or the company shares are owned in the risk taker's name as well. Alrighty, so if we look at this structure, where is the risk? That's kind of what I want to get everyone in the frame of mind is, okay, let's say you operate a trust as a business or a company over here as a business. Where's the risk? And this kind of touches on Olivier's question before of, who's exposed. So I just did a new slide and I colored in green is where the asset person sits and controls, and oops, just flicked again. Sorry. There we go. So red is risk, green is safe or asset person. So in where the company operates the business, we're looking at the company. Any assets inside the company are at risk, but the trust assets down here, we probably call this an asset trust. They are not at risk. Similarly, up here, the whole thing is actually, so any assets in the trust or any assets in the corporate trustee are at risk. We don't often see assets held in the corporate trustee on its own. So that's a bit weird. There's some situations where we might, but it's not common. But yeah, that's a quick glimpse. But if you're the shareholder of the corporate trustee or the shareholder of the trading company, in this case, it's the trust, you do not take risk on as a result of that. Alrighty. Now we've talked about structuring your business. Now, in terms of other things we see unit trusts or holding companies. There's additional structures, but I just wanted to kind of keep it simple between the two main ones, and they have similarities between the two. I've just got a question from Matt. I'm just going to read it first. Seems a complex one. Okay, Matt, yes, you are correct. So Matt's question was, let's say we had a trust and there was an individual trustee of that trust. Is that definitely not for an asset person? And I would absolutely say yes, you would not have the asset person as the trustee of a business trust. And in fact, I'd recommend against having any person as the trustee. I would absolutely recommend a company. Because of that additional protection. Alrighty, we're going to switch gears to investment structures. So what we commonly see there, it's a slightly different, because with investment structures, we don't have the risk of running a business. Now, there might still be risk if you own, let's say, commercial property or even residential property. You still have contracts with rental agents or your tenants, especially in commercial where you've got like literally a 60, 100-page contract between you and the tenant as landlord. But generally speaking, you've got a lot less risk than running a business, especially let's say where you own shares in the share market in these entities. So how do we normally do that? Funnily enough, there's two main ways. The one on the left is actually the most common, where we've got an asset trust that owns the investments. Now, we've still got a company trustee. I'm a little less strict on asset trusts having company trustees or individuals, only if it's the asset person being the trustee here. It does save the setup of another company and the ongoing ASIC fees associated with that. So I am open to an individual trustee, but only in investment structures. I would literally refuse to set one up back as a business structure with an individual trustee. We just won't do it. And we can do it. We've just made a decision not to, because it just doesn't make sense for us. And we don't want to have, we're not taking responsibility anyway, but I don't want to ever have that conversation with a client that ends up in strife because of it. And then the reason why asset trusts are more popular with investments is because they offer the capital gains tax discount. So trusts have discounts if you own your assets more than 12 months. So let's say you buy a rental property for $500,000. 3 years later, it's worth $1 million. If you've owned it for more than that 12-month period, we get a 50% discount on the capital gains tax that you pay. in the trust. Now, if you owned it in a company, which is this alternative, you don't get the CGT discount when you sell the asset, even if you've held it more than 12 months. You do get a fixed tax rate though. So a bucket company or an investment company would pay tax at 30% versus a trust that will need to distribute that capital gain out to the family members in the group. Now, with a company, even a bucket company, we need shareholders, and here I would recommend an asset trust anyway. So an asset trust that owns the shares in the bucket company. Again, I'm okay having an individual trustee for this one here as well, because it's an asset trust. So Phil's got a question. It's related to the trading entity, but trading co with a trust as the shareholder is a better asset protection. I would actually say that, Phil, in terms of asset protection, I feel like these are similar options. So you've still got the corporate veil in both of them. It's actually differences in tax that would make you choose one here over the other. So they're equal in asset protection, but different in their tax outcome, or at least the way that tax is paid throughout the family group. Alrighty. So yeah, that's kind of the overview for the investment structures. Now, in terms of bucket companies, we don't have, where we start to look at bucket companies owning investments like property or shares is where the family or the household income exceeds about 400 grand a year. That's where we start needing to own assets in companies. The reason for that, it's a tax reason, is because Division 7A gets quite difficult to deal with over that sort of income. So 400, 500 grand or more in household income, we are probably going to lean towards this. But again, we've got clients where we own property in asset trusts and the share portfolio in the bucket company. The thought process there is with shares, you can sell a very small portion. You can sell one share if you wanted to, out of, let's say, 100,000 shares you own. With a property, unless you're selling it to a related party, like a tenants in common sort of thing, you either sell the property or you hold it. You can't really sell a share of it. So, so when we're looking at managing capital gains tax as a result of that, we know that we're going to sell this property in 1 year. We've got to deal with that. We probably want access to that 50% discount if we can get it. With the shares, we can sell that across multiple financial years without a huge tax burden on it. So that's why we might look at a bucket company to own investments. All righty. Now, I'm going to switch gears into advanced asset protection. I've kind of got a couple of points here. But again, this is kind of the time where we want to open up for Q&A for anyone who's got unanswered questions. So if we start with this first one here, the old gift and loan back. Now, what this does, the concept here is that, let's say you've got a risk taker with, they might own half the home. If there's equity in that house, and equity is calculated in the house as the market value of the house less the debt associated on that house, and we would apportion it. So if you've got spouses that own the house 50-50, it would only be half of the equity in the home that would be at risk. Now, if we've got that, one of the, and we don't want to go and sell their share of the house to the other spouse, spouse in the relationship, we can gift the equity into a trust, and basically there's a loan back owing from the risk taker to that trust for that amount. So they actually, what it causes in effect is to have zero equity in that person's name. Now there's a whole heap of rules around it. There's even been slight changes on how that has to be done, even in the last 6 months or so. And it is an advanced strategy, like that sort of thing on its own, you'd be looking at about 6 grand or more potentially, depending on your setup, to go and implement something like that. So again, we start looking at the cost of implementing this solution, let's say, versus just taking the stamp duty hit. And again, there's a conversation around pros and cons of either that needs to take place there. I think Mark's asked a related question here. If selling the property to the trust can you reduce the price to reduce the stamp duty? Unfortunately, we can't. So when we're looking to sell between related parties, whether it's one spouse to the other or you to a trust, that sort of thing, there's rules in capital gains tax land and also stamp duty land where you must use market value. If you don't, there's penalties, and it's basically tax avoidance. So yeah, a bit of a naughty one if you go and do that. Santosh has asked, was there not some news recently on some court case in Queensland? I'm not sure which state it was, but yes, there was a court case around gift and loan backs, and that's why they need to be considered very carefully. And I worked in with a lawyer that actually knows those and has updated their deeds and all that sort of stuff for that, even that recent case. So yeah, we work with partners who've done some announcements and updates there. Cool. Another one here is successor directors. Now, this is actually a requirement. If you've got a single director company and let's say you're the, I'll give an example where you run a company as your business, the risk taker is the director, and they're the only director. Now, if that director passes away, there's now no directors of the company. Now that's like a divide by zero error. We can't have no director of a company. So what we've needed to put in place recently for our clients is this thing called successor directors. If there's only one director, we pretty much need this in place, where it says if this person passes away or is incapacitated, we need to appoint this successor director in their place. Now, again, we want to be careful when it comes to estate planning and also asset protection of who we appoint to that role as well. Cool. The third one here is leading member trusts and SMSFs. So this is great where you've got the analogy actually that's used by the mentor I've learnt this off is the royal family. So the royal family have a very clear succession of this person's in the throne. Then if they pass away, which the Queen has done recently, then this person's in the throne and so on. So you can actually go and Google the royal family's succession line and have a look at that. But what this concept of leading member trusts and SMSFs does is have that in place as well. It gives a master vote for whoever's on the throne, and the throne passes per the trust deed or the SMSF that's predetermined. So when these trusts and SMSFs are set up, they can be changed along the way by the leading member or the person on the throne, but they're set up so that you kind of protect against, family nonsense that might happen, or, that sort of thing. But the person who has the final say, we would appoint as the leading member, and then consider who would be next after that, with maybe 2 or 3 or 4 successors after that, depending on the family group. So that's another advanced asset protection thing. And the scope of that might be protecting the family wealth from, let's say, extended family in that context. So yeah, this conversation or this chat around asset protection can go in many different ways. It can cross into tax, it crosses into estate planning, SMSFs. So it's extremely complex and very much depends on people's individual circumstances. John has asked a question, is it better to hold assets in an SMSF or a bucket company / trust? So an SMSF compared to a bucket company or trust is actually another level again of asset protection. So it's very hard for creditors to come after your superannuation unless you've known something bad is happening and you've gone and chucked a whole heap of assets into super. So let's say, I'm trading in Salford, quick, get the 200 grand into super. That transaction could probably be easily unwound. But if you're not doing that, then your superannuation or your SMSF is actually quite a safe place. Plus, it's very tax effective. So the tax rate in super is 15% while you're growing your balance, or 0% when you're drawing a pension and you're over 60 or 65, depending on the circumstances there. But but so superannuation or SMSFs are very beneficial when it comes to assets. So yeah, the context of my sharing around what investment vehicle to use would be just looking at outside of super. Phil's asked another question. Setting up successor directors, is it? That's okay. So, so the cost is a few $100s to get that set up. The successor director deed, or the legal document we need to produce for that, and it's not difficult. We just need obviously the company name, the current director, and who the backups will be, who are those successors. It's a pretty good implementing your successor director strategy is actually a pretty good thing to do when you're doing your broader estate planning as well. So when you're looking at your will and your power of attorneys, testamentary trusts and things like that, because what'll often happen is you'll establish that that lineage, or who's next after the initial person and so on, and you'll often find that they're probably going to be the same people you'll want in your will, or acting as power of attorneys, or that sort of thing as well. So it's a good time to kind of get all of that done at once and updated if they haven't been done in a few years. So yeah, on its own though, Phil, the successor director is just, yeah, a few $100. But we can, if you're keen to suss that out, then feel free to reach out to me or Karan. Thank you. Alrighty. There is no other questions, but I'll kind of wrap up the formal bit, and if there are any more last ones, feel free to pop them in. Now, there will be a recording of this webinar if you've missed any bit of it or you'd like to share it. We've got social media accounts on all those places you see on the screen, but we do host our webinar recordings on YouTube, where we've got all the past ones as well, if you do want to check out the things we've done in the over the last few months and years. Also, if you aren't working with us as your accountants and you'd like to explore what that might look like, then please feel free to book in for a strategy call. The link should be in the chat box any minute now. But I do want to say, hey, thanks for joining. Really appreciate the people who've shown up, and this was actually one of the most registered for topics in a while. So it hit the nail on the head with relevancy, I think. So thanks, Elisa. Appreciate the note. But yeah, I'm here for the next few minutes if anyone's got some more questions. Otherwise, have a good tail end of the week.